What exactly is cryptocurrency trading, and how do people actually make money or lose it in this market? Let's break it down in the next 5 minutes. At its core, crypto trading is the act of buying and selling digital currencies like Bitcoin or Ethereum. The goal? To profit from the constant ups and downs in their prices. It's a bit like a high-speed digital version of the stock market. So, how do you trade? There are two main ways: spot trading and derivatives trading. Think of them as two different doors into the same market. Spot trading is the most straightforward. You buy the actual cryptocurrency, say, 1 Bitcoin. It goes directly into your digital wallet and you own it outright. The idea is to buy it at one price and sell it later when the price is higher. It's the classic buy low, sell high strategy. You hold the asset, and your profit is the difference between your buying and selling price. Then there's derivatives trading, which is a bit more complex. With derivatives, you're not actually buying or owning the cryptocurrency itself. Instead, you're trading contracts whose value is based on the crypto's price. This allows for more advanced strategies. For example, you can go long if you believe the price will go up, or you can go short if you predict the price will go down. Shorting lets you profit from a falling market, which isn't possible in basic spot trading. It's a powerful tool, but it also comes with higher risk. One of the most unique things about the crypto market is that it never closes. Unlike the New York Stock Exchange or other traditional markets that have opening and closing bells, the crypto market operates 24 hours a day, 7 days a week. This means opportunities can arise at any moment, whether it's midnight on a Tuesday or Sunday afternoon. This non-stop nature contributes to its famous volatility. Crypto prices can swing dramatically in a very short time. A coin might surge 20% in a few hours, or it could crash just as quickly. This high volatility is a double-edged sword. It creates the potential for significant profits, but it also carries a very high risk of substantial losses. So, how do traders navigate this volatile landscape? Many rely on what's called technical analysis. They study price charts, look for historical patterns, and use mathematical indicators to try and predict where the price might go next. If you've ever seen those charts with lots of lines and strange shapes, that's technical analysis in action. Others prefer fundamental analysis. Instead of just looking at the price, they dig deeper into the crypto project itself. They research the team behind it, the technology it's built on, and its real-world use case. They're trying to determine the project's long-term value, believing that a strong project will eventually see its price rise, regardless of short-term market noise. No matter the strategy, successful traders have one thing in common: they master risk management. They never go all in on one trade. They use tools like stop-loss orders, which automatically sell their position if the price drops to a certain level, to protect their capital from big losses. Think of it as a safety net. Many beginners fall into common traps. They might overtrade, making too many moves based on small fluctuations, or they might get caught up in hype, buying a coin just because everyone on social media is talking about it. The biggest mistake is often risking too much on a single trade. Avoiding these pitfalls is crucial. Ultimately, the market is driven by two powerful emotions: fear and greed. Fear causes panic selling, and greed leads to irrational buying. The best traders learn to control these emotions. They create a trading plan and stick to it, making logical decisions instead of emotional ones. Before you even think about putting real money on the line, education is key. Learn the basics, understand the risks, and practice with a demo account if possible. In trading, experience and knowledge matter far more than luck. And it's important to remember that trading is not the same as long-term investing. Investing is often about buying and holding for years, believing in a project's long-term vision. Trading is an active short-term strategy that requires constant attention and decision-making. So, understanding how crypto trading works is the first step. Whether you decide to trade or not, always respect the risk involved and never, ever invest more than you are prepared to lose. If you're interested in learning more in a safe environment, you can check out platforms like Binance to get started with your education. I've left a link in my profile if you want to sign up. Just a quick heads up, this isn't financial advice. Investing in crypto is high risk, and you should always do your own research. I may also earn a commission if you use my link to sign up.